we have never seen these levels of sentiment without a subsequent recession. The reason I believe that we are not in that particular position is that sentiment now is much more about prices than it is about income.
Mark Mathews, welcome to Macro Talk.
Thank you so much. Thanks for having me.
Oh, thanks for having me back at the big show. This is my third year in a row. Fourth year in a row? I've lost track, but I've always loved starting my year with this conference because I think it's really well organized. I love seeing all the people from all over the world come, and your session is one of my favorites as part of the press. Now, I haven't seen you in a while, so congratulations first off on your promotion to Chief Economist.
Thank you so much.
There's a lot to talk about, and I want to frame our conversation specifically on what you think the retail industry is telling us about the economy that other parts of the economy aren't really capturing.
Yeah, it's a great question. And I think what we really see is right now, the consumer is the bright spot in the economy. When we look at GDP growth, the consumer is driving GDP growth. Over half GDP growth comes from consumer spending. So right now, when we look at the other components of GDP, we look at business investment, we look at imports and exports. We see a lot of variability in there. The one consistent is the consumer. And really, when we look at where we forecast retail sales to come out, back in March, we have seen consumers really step up, and we expect to actually blow past some of those forecasts, which is really surprising given all the crazy stuff that we've seen over the course of the year.
How would you describe 2025 in 3 words?
Yeah, so I saw Mohamed El-Erian speak yesterday, and obviously he's a famous economist, very compelling speaker, and he started off by saying that us economists mostly got it wrong, right? Because we expected tariffs to be much more impactful than they have. But really what we've seen is that as opposed to passing those costs on to consumers, what importers and retailers have really done is absorb those costs, which has allowed inflation to remain at a much lower level than we might have expected. And the important thing to recognize when we think about consumers and their ability to spend, wage growth versus inflation, right? So real wage growth. We have seen consistent real wage growth for the last 30 months, which has allowed the consumer to continue to spend. And one thing we know about the consumer is all year long, they have been preferencing spending on family and loved ones, right? So every event, Mother's Day, Father's Day, Valentine's Day, back to school, all of those have been at or near records. So really, the holiday season as well has been about the consumer stepping up and spending on family and spending on loved ones. And like I said, that's really the bright spot in our economy right now.
But what would you say the 3 words are? If you had to describe 2025 in 3 words, the 2025 economy in 3 words.
Resilient would absolutely be one of them because I think with so much stuff being thrown at us, the consumer has been really resilient. Surprising is another one because I feel like a lot of us didn't expect us to be where we are right now. So it's definitely a surprise for me to see how well and how strong the economy has been. And the final one would be momentum, right? When we think of consumer spending, it's been really hard to derail. Everyone is, when you look at media, you look at, analysts, they've been talking about, this could throw us off course, that could throw us off course. The consumer has maintained momentum, and that gives me a little bit of hope when I look to 2026, because consumer spending is just something that's very difficult to derail.
The latest that we've seen with respect to the makeup of the consumers is that the top earners are really driving most of the spending. So when you look around, at this conference today, is that really where companies are now focused, is trying to go after the deeper dollars of those higher income families and households? Or are they still playing with a playbook that looks at consumers across the income spectrum?
Yeah, I think a lot of retailers don't have the option to suddenly go and start saying, I'm going to target wealthy people, right? If your goods that you have are generally targeted towards middle or lower income households, you can suddenly say, yeah, I'm gonna turn myself into LVMH, for example. So I think really what retailers have been forced to do is, we have a consumer, we know that sentiment is incredibly low. Uh, However, spending has been really, really robust. So what we have is this dichotomy between spend and sentiment.
Mhm.
The way that that's manifested itself is that consumers feel really cautious and really, really price sensitive. So I think the message for retailers is, you need to make sure that the consumers believe that you're offering them the best value, right? The best product at the best price. And I think the sectors that we've seen outperform have been the ones where, we see consumers believe that if they walk into that store or they go to that website, they're going to get the best possible price.
You were talking about how a lot of companies actually absorbed the shocks from tariffs. Was that mentality because they may be aware that sentiment is so low that if they were to have increased prices, they would have scared consumers off?
Yeah, it's such an incredibly competitive environment that we're in. So when you have people who are worrying about things like, our business is going to take advantage of the ability to raise prices and inflation, the reality of the matter is that it's incredibly competitive, and therefore retailers have to go out and they have to offer consumer, because we live in an age where consumers have more information than they have ever had before. Price discovery when I was younger, it used to be, how far can I drive while stores are open? But right now, with the tools that consumers have available to them, there's total price transparency. So really, retailers are in a situation where they have to have a compelling offering to consumers. But what certainly is interesting is you mentioned, the difference between consumers, right?
Mm-hmm.
And when I talk about retail sales growing at 4%, which is above trend, and that's the surprising thing, right? We saw retail sales grow faster than we expected, but it's not happening across all buckets, right?
Mm-hmm.
So we do see those higher income households spending more, and we see those lower income households being more challenged, right? And the reason for that is, if you look at income growth, right? For a long time, lower income households saw higher income growth relative to everyone else. In the past year and a half, that has cratered, right? So lower income households' income growth has slowed dramatically as inflation hasn't dropped as much. So you've seen a squeezing of real earnings for lower income households.
How much of that growth that you're talking about and the spending, just pure dollars, actually comes from just the increase in prices versus just pure demand?
Yeah, so there's definitely been a boost to retail sales based on the fact that prices have risen. But generally speaking, we're probably only talking about a quarter of that being inflation driven, and the rest of it being real actual growth. I do think that as we move into the first quarter, retailers are going to have a much harder time eating some of those prices.
Why is that?
Simply because those, retailers have been able to take advantage of efficiencies. They've actually absorbed a lot of those costs. You can't do that indefinitely, right? Wall Street will start to punish you. Your shareholders will start to punish you. What they can't be is in a situation where, their margins start to deteriorate. So we do expect a lot of, a lot more transmission of cost to the consumer as we move into the year. The saving grace, though, is that services inflation has been soft, right? So while we've begun to see goods inflation tick up a little bit, it's been compensated for by the fact that services, which is 70% of our economy, inflation in that sector has been a little bit weaker.
What do you attribute the difference to?
Yeah, no, it's really most of the weakness we're seeing in services inflation is in housing, right? So we've seen a softening of rents, and when the BLS measures CPI, when they measure inflation, they measure rents, but they also have an imputed measure for people who live in houses, because theoretically you're paying a cost for being in your house, even if you own that house. So those measures have been declining, and those are major costs, right? So I think the saving grace for the U.S. consumer has been that services inflation has not continued to rise. Because if that were the case, instead of 3% inflation, we might be talking about 4% inflation.
I know you chose three words: resilient, surprising, and momentum for the three words of that you think best describe 2025's economy. Is that through the lens of the retail industry, or would you say that's the general kind of consensus among economists of 2025?
I think it's more, when we look at the consumer, but when I look at and I speak to other economists, surprise is definitely near the top of the list, right? Because I do think a lot of economists thought that things would be a lot more difficult, a lot harder, and there would be more severe consequences. When we look forward and we look at fourth quarter GDP, there are forecasts right now saying that fourth quarter GDP could be close to 5%, which is a big number, right? And the really surprising thing is that we have never seen a period in the history of the U.S. economy where we could see 5% growth with almost no job growth. So this incredible disconnect between employment and GDP is something that's phenomenally surprising. It's shocking.
And is that a reflection of the K-shaped economy?
I don't know if that's a reflection of the K-shaped economy. I think it's really got to do with the fact that when we think about employment, we think about supply and demand, right? Mm-hmm. If you go back 2.5 years ago, we needed to create about 250,000 jobs a year to keep unemployment level, right? And that's what we want, right? We want unemployment to be, consistently low. Right now, our economy probably only needs to create between 30 and 50,000 jobs a year to keep unemployment level.
What is that number saying to you?
It says that we have a very uncertain business climate, right? If we look at retail, we actually had 1 month in 2025 where we hired fewer people in that month than we had in the past 25 years. When you have all this policy uncertainty, the easiest thing to do is sit on your hands, right? Because you're not sure what the next, 6 months, let alone the next, couple of months looks like. It's very difficult to hire into that sort of a climate, right? So we've seen a lot of businesses be in a situation where they have pulled back on capex, right? And not just equipment, but human capital. At the same time, we've had this weird thing where AI investment has been going through the roof.
Yep.
So we had trillions and trillions of dollars of AI investment, but not nearly the same amount of investment in machinery and people.
I was going to ask that very question. Is across the board, have you seen an almost direct one-to-one replacement of investments, or maybe even the ratio is even higher, where money that would have been spent on talent is being funneled over to AI?
Yeah, so I don't know if you can make that
marry them together.
Yeah, okay. I do think that there are a number of reasons why we haven't been hiring as many people. I think the real interesting thing is that when you measure capex investment and AI investment, you're measuring trillions of dollars. When you measure revenue that comes from that, you're measuring it in billions of dollars, right? So the thing that you have to hope is that for all the businesses involved, that you begin to see a ramp up in the revenue that matches that capital expenditure. Because if you don't, then you get into a situation where businesses have a lot less to invest as we move forward. And I think when people think about recessions, they think about the consumer. The reality is, when we look at the last 8 recessions, the number one driver of GDP declines is business investment, right? So we've actually had recessions where consumer spending was a positive contributor to GDP, but we lost GDP because businesses weren't investing. So the big message here is that what is really driving our economy is business investment, because that creates employment and that creates wage growth. And those two things right now are the critical factors as we look forward to how our economy is going to perform, because we need wages to continue to exceed inflation and we need people to be employed, right? If those two things begin to become challenged, then our economy is going to be in difficult straits.
You mentioned earlier the continued disconnect between soft data, sentiment data, and the hard data that's come in. Specifically with just the lens that you have on a daily basis, the retail lens, what does that lens tell us about the U.S. economy that the labor economists are missing?
So here's the thing about sentiment, right? And I'll address this in 2 ways. And by no means am I blaming the media here, but there was a study done by Brookings recently that looked at media negative mentions and equated it to economic fundamentals. And the conclusion of the study was that the negativity gap between negative press and economic fundamentals has exceeded where we were over the last 30 years by 5 times. So we have 5 times as many negative mentions as related to economic data. So when you think about a consumer that's already feeling a little bit cautious, that has an impact on sentiment. But I'm not going to lay all the blame on the media because I do believe that consumer sentiment has become nothing more than really an inflation gauge, right? So if we look at, especially the University of Michigan Sentiment Index, when that has been low, there have been 2 other measures that tend to correlate very strongly, and that is people saying my situation is worse because my income is lower, and people saying my situation is worse because prices are higher. What we've seen over the last couple of years is that people saying that my situation is worse because my income is lower has completely dislocated from sentiment. And sentiment is tracking very, very closely with people saying my situation is worse because prices are higher, right? So our sentiment isn't really about our income levels. Our sentiment is about price levels. So we are a consumer that is overly concerned about price. And I mentioned to you earlier, the consumer we know is incredibly price sensitive and what we call promotional, right? Looking for sales, looking for the best possible deal. That is a reflection of this low sentiment. And that's where this dichotomy comes from, because we have low sentiment, but we have the ability to spend because wages have continued to grow and unemployment is, 4.4% is the latest reading. If I think back 30 years ago, we considered, full employment to be 5%, right? So we are still at historically low levels of unemployment. So we have a population that has jobs, and we have a population whose wages are growing. And that gives them the ability to spend even though sentiment is weak.
Do you think that there are areas of real concern from the sentiment data? I mean, in some ways, in the past, we could have relied on it as a leading indicator that, sentiment was down, they might be spending less, and that hasn't happened. We know during the pandemic, everything was upended because of the extra savings that were injected. But is there anything that you see that is giving you a reason to stay up at night, that you think the sentiment will actually lead to behavior change?
There are a lot of things that keep me up at night.
Fine. But on this particular surprising storyline that has momentum.
Yeah. So, there's a saying that, the hard data catches up to the soft data, right? Because historically, we have never seen these levels of sentiment without a subsequent recession. The reason I believe that we are not in that particular position is what I just said, which is I believe that sentiment now is much more about prices than it is about income, right? It's much more about I feel bad because I feel prices are high, not because I don't have the money to spend. So that gives me less concern about where sentiment is. It does give me concern about where sentiment is going to go, because if sentiment is a measure of inflation, it could soften, but we measure inflation on a year-over-year basis, right? That's not how the consumer sees it. The consumer thinks about what was I paying 5 years ago, what was I paying 10 years ago. So it takes a long time for people to start feeling better about inflation again. And the really important thing to remember is that when we saw in 2021, 2022, CPI hit 9%, most of the people who are around today had never experienced that level of inflation before. They weren't around the last time we had big inflation in the 70s. So I think this has been a really jarring thing for a lot of people. And people see those prices, those eggs prices, those beef prices, and that takes up a bigger space of head share than their wage increases, right? So again, I get back to this notion that consumers are spending their financial, their financial situation, but they are very, very affected by what's in their head when it comes to prices.
So you're not blaming the media. The evidence is there. You're not blaming millennials and Gen Z for not having lived through this, but it is sort of as part of the cycles as they have cycled through different life stages. There's a group of people who obviously haven't experienced that. I hear you on this. If you were to guess or to estimate or think about when the hard data might catch up with the soft data, what would have to happen in order for the data to actually catch up? And so how much time do we have until that point?
I think what we really need to see is wages decrease. Because once they decrease and you have actual inflation exceed wages, that reduces our ability to spend, and unemployment. Like I said, those two things, if we see weakening in terms of employment and we see weakening in terms of wage growth, those are the things that are going to drive the economy down. I think the positive, though, is that when we have high inflation expectations, and right now we continue to have very high inflation expectations, that tends to drive wage growth, because we ask our employers for more money, right? Because we feel like prices are rising. So as long as businesses are able to continue to provide higher wages and we have real wage growth, I think we're going to be okay. So really, I don't see sentiment driving economic problems. I look at it the other way. I look at the economy, I look at unemployment, I look at all those things. Those are the things that are going to potentially, if they turn downwards, create a situation where the sentiment matches the economic data.
Yeah, it is a bit of chicken and egg with the getting a raise because of inflation. I think, as anybody has known, trying to get an increase in their salary. Just last question on this. I know we've been talking about it a lot, but I really want to understand clearly here. Like, if you are a consumer thinking about these headlines and you're a business person, you're looking at this, it sounds like the message you have for both of these groups of people is that you shouldn't be so worried right now about it. And at the same time, I do wonder, because you said earlier that we're creating fewer jobs and the economy needs to have fewer jobs. Is there something that in this year, if you were to see the average dip below 50,000, that would cause you to raise a few more alarm bells? Is that a good summation of all the themes that we've just talked about, trying to connect those dots?
Yeah, I think the thing that will set off the alarm bells is if we begin to see unemployment tick up towards 5% and above, right? So I'm less concerned about are we creating 50,000, 60,000, 30,000 jobs a month. I'm much more concerned about what that means for unemployment, right? So if unemployment starts to tick up, that means you have fewer people in work and fewer people able to go out and spend. But I do think right now, if I had to say, where is the consumer? I wish this were something that I had come up with, but I'd read someone say that consumers are griping but swiping. That is really where we are right now. Consumers are uncomfortable, but consumers continue to spend. And I don't see that. I don't see a lot of things changing that scenario unless, again, like I said, we begin to see businesses start firing, right? We know they're not hiring right now, but they're not firing. And that's a big positive for the economy.
We're in a stalemate situation. It's still frozen-ish.
Right. If you look at retailers in the holiday season, we did not see a lot of retailers hiring as they have in the past. Part of that, when we talked to them, is that they felt like they had enough employees, right? Because they're not letting employees go. I talked to you earlier about very, very low rates of hiring. That has been matched by very, very low rates of what we call separations, right? People either quitting or people being let go. So as long as those two things remain in equilibrium, we're going to be okay. But if we begin to see a tick up in people being let go, that's where the economy, I think, starts to turn.
How much of an impact did the lack of consistent government data in 2025 have on your role to model, to think through and advise companies on outlook and forecasting?
It's really important.
But did it have a big impact, a small impact? Like, how would you quantify, characterize the impact it had on you last year?
I would say it had a small impact because this is something that I've been worried about for a long time.
Really?
Yeah, because I have a lot of value. I ascribe a lot of value to government data. I have the utmost respect for the people who work at the BLS, Census, BEA, all those people, the jobs that they do. I know they work incredibly hard. I know they do their best. But at the same time, I also know that the world is changing and we have access to data that we never had before. And that's why at NRF we created the CNBC NRF Retail Monitor powered by Affinity Solutions because I feel like we are living in a world where everybody needs data faster, right? So we've been planning ahead. And that's why I say it had a smaller effect, because I'm always looking at alternative measures because it does take a long time for the government to put their data out. It's still really important, but now it's more important in hindsight, right? Did the data that came out before, does it match the government data that comes out later? Do we need to recalibrate? So I do think that as we look forward in the future, we are going to see the government data sources become more challenged. If we look at the Census Bureau and their retail sales, it wasn't just the government shutdown that created an issue. They're getting fewer and fewer respondents to their surveys, right? We as human beings, we're inundated by surveys, and I'm part of the problem because I push out a lot of surveys. But we're seeing fewer people respond. So I think it's incumbent on all of us working in the industry to find other ways of measuring the economy.
If you were to look at, I think the NRF CNBC that partnership that you guys have, it's been about what, 2 years?
2 years.
2 years.
Yeah.
How much of a difference has there been in what you see and when the government retail sales data come out? What have been some of the biggest areas of disparity?
Well, what's really interesting is that the reason we chose the data provider Affinity Solutions is because they have a 0.98 correlation to census on a raw basis, right? So their data has always correlated very strongly with census data. and it continues. Actually, when we looked at the numbers again a couple of weeks ago, we still maintain a 0.98 correlation. That gives me a degree of comfort. If we begin to lose correlation, that's when I begin to worry. Right? Is it our data, or is census data becoming more challenged? We do know that when we had the government shutdown, and BLS did release some data and Census released some data. A lot of people were questioning the data because they didn't have as many survey responses, and they're having to do what we call impute, particularly when it comes to CPI. The moment you have to start imputing, which is assuming prices based on other prices, that's when things start to become, start to get called into question.
A lot of people might also question the authenticity of a publication, coming out of NRF about, the industry, of course. I mean, we have these conversations in our newsroom all the time. Who did the survey? Oh, the retail industry said the retail is doing great. Well, yeah. Help those who are watching and listening to this understand what, if any, bias there is in the presentation of your own modeling and predictions and figures.
Yeah, if we were putting out bad data, it would harm us so much more than anything else we could do if people discovered that we were biased. So it is my particular concern that this is all seen as being incredibly accurate. And I've been arguing at NRF, I've been at NRF for this is my 10th big show.
Yeah.
I've been saying that we need to do this, not because, I necessarily want to be at the forefront of releasing data, but because I do think it's so important to have alternative sources, right? We don't know we don't know where, the BLS and Census are going to, we have no idea what government funding might be in 2 or 3 years. But not only is it important, I want to understand the why, right? And the challenge for me has always been, when I look at census data, I see numbers, but I don't see the why, right? So
isn't that your job to figure out the why?
Well, it gets a lot easier when you use credit and debit card data like we do, and you can see much more granular. You can see almost down to the transaction level, and you have consumers who are attached to it. So you can see what are low-income consumers doing, what are high-income consumers doing, what's Gen Z doing, how are people shopping. I want to understand that because I want to be able to interpret the data and understand it better. So that for me is the real big thing. So there are people in our organization who absolutely care. We want the retail industry to be incredibly strong. I'm much more concerned about understanding the whys, right? So if the data is negative, I worry less about that than why the data is negative, right? Why were the numbers down? And if we can understand that, I think we add a lot of value to the narrative about what's going on in our industry.
Yeah, I mean, economics is a social science at the end of the day for all intents and purposes. What are your favorite alternative sources of data outside of your own, of course?
So I look at Bank of America, their consumer checkpoint. That's always interesting. I'm always looking at some of the Fed's newer tools, like their real-time GDP. It's called GDP Now, and I give a lot of credit to the Fed in particular for recognizing that we need tools that are much more in the now moment than looking in the past. But yeah, there are lots of different sources out there. When you get into the holiday season, Adobe's putting out data. As someone who lives in news, that there are many different sources out there, many different views of what the truth is.
Yep.
And I am always measuring myself against all those different sources and seeing, are they seeing the same things I'm seeing? I have people on speed dial who work at organizations that have a lot of data that don't put it out, and I'm always checking with them.
Who are those people?
I can't talk about those, but we are always checking to make sure that what we're seeing is what other people are seeing, and if there's a disparity, then we have to understand why there is a disparity.
And is there a lot of disparity when you're on these secret phone calls and you look at everything else?
Secret phone calls.
I mean, what happens? Like, if you are on the phone with this person that's somewhere else,
this sounds nefarious.
do you guys figure it out? Like, what generally is the cause for a disparity?
So that becomes part of the conversation. So why are you seeing what you're seeing? What's your sample
Input,
size?
right?
Is your sample biased in a certain way? We know that some samples have a higher preponderance of higher income households in their survey. So are you being skewed because of that? What's your geographic representation, right? So some geographies are doing better than other geographies. So we need to dig into it and figure out why there is a disparity there. And if we can't figure it out, then we move on to the next month and see, is it replicated? And if it's replicated, then that's where we start to see a problem, and that's where we start to dig into everything and figure out what's going on.
And I guess, is that why you prefer in some ways Bank of America versus, let's say, like an Amex, just because Bank of America's got a broader base of consumers than like the Amex and MasterCards?
No, I absolutely value the Amex and the MasterCard data.
Sure.
It's just that Bank of America comes out early and they put a lot of stuff in the public domain. Now, if you come see me on Monday, the economist from Bank of America Institute will be on the panel.
Perfect.
And you can ask him.
I will.
You can ask him some of those questions.
I got you. Let's talk about the predictions that y'all made back at the beginning of 2025, the late end of 2024. A couple of them that I was looking back on that I wanted to run through with you to check in to see whether they were the driver that y'all said that they were going to be. 2025 being the year of the AI agent, did that come to fruition?
Yeah, I think there's lots of different ways to think about that. And the challenge we found with the consumer is a lot of the consumer doesn't even know if they're actually using AI, because we've seen this incredible sort of meshing of Google search with AI search. I do think when you ask consumers the question, are you using an AI app? Mm-hmm. So are you going into the app and doing it that way? We see the response rates be a lot lower. But when we ask about, is your search touched on by AI? The answers are much higher. So absolutely, I do think AI is playing a much bigger role in search.
Live shopping, did it catch fire?
I don't know if I would say catch fire, but it's definitely, it remains a thing.
And if you were to look back at the major tailwinds and headwinds for the industry back in 2025, what would you say those were, and how many of those will carry into 2026 and change?
I think in terms of headwinds, policy issues, tariffs, all those sorts of things were the major headwinds. I do see them having maybe a little bit less of an impact in 2026. We're still waiting is the Supreme Court decision, but I do think that the most important thing is for businesses to have more certainty, because uncertainty is the economy killer, right? So hopefully we have a situation where even if the policy changes are challenging, that at least we know what they look like for a consistent period of time. And I think in terms of tailwinds, it really probably consumer wealth. We have tremendous growth in stock markets in almost all asset classes that has allowed consumers to feel a lot wealthier. I think that's an important tailwind, along with wage growth. As long as we continue to have household wealth grow, and right now it's at a record. No stock market crashes.
Yes.
Knock on wood. Hopefully we'll be okay.
So, for businesses, in particular, around the chaos that was, a little bit over a year ago with the tariff changes that came out every other day, a lot of companies had already gone through the process of reorienting supply chains and their practices. Do you largely expect those to be permanent, or do you expect them to continue to reflect the operating and policy environment?
Yeah, I think all businesses are looking for is consistency, right? They want to know that if I move my supply chain to a certain region, that region is not going to suddenly be hit by punitive tariffs. I do expect businesses to continue to look at options, right? We've in the course of my lifetime, my mom was Japanese. I remember growing up. Japan was seen as the low cost.
People
place,
forget
right?
about that.
Yeah, exactly. I mean, Japan was seen as a place where you got cheap stuff, right? And that has shifted dramatically over time, and it will continue to shift. And if anything, it will accelerate, right? So I do think that retailers, like other businesses, need to remain on their toes and continue to look at sourcing as something that isn't a constant, right? You have to continue to be flexible. If the pandemic taught us anything, circumstances can change in a flash. So I do think agility is a major issue for businesses, not just retail.
For business leaders watching this, and if they are not in the retail sector, what should they take away from this conversation, but specifically on how to look at retail and its relationship to the overall economy? Would you say that retail is a leading indicator of the economy? Is it a real-time reflection of the economy? I really as so many of our industries are now more interconnected than ever. And so one of the goals, again, of what I'm trying to do is to show how everything is interconnected. And so, again, the question is, how does retail fit into the larger economy? What does it represent, really, and for others to pay attention to?
Yeah, it's such a great question, and I probably need I need 24 hours to really think about it. My first impression is, is retail a leading indicator? No, I don't think retail is actually a leading indicator. Retail is probably a lagging indicator. If you look at, for example, why retail is dying in an area, it's probably because something else happened, right? Did a manufacturing plant close down and people start moving away? Is there a demographic shift? Are people leaving? Are young people leaving? All those things become reflected in retail. So retail tends to be a reflection of what happens around it. So if we think back to the whole retail apocalypse, the mall is dying, that wasn't actually happening. What was really happening was that those smaller format malls that were in rural locations were struggling because the demographics were changing, because the competition was changing. So really, I do think when you think about retail and you look at it, and you look at the success and you look at the failure, you have to look at the broader ecosystem and understand what's happening there. So I think that's something that I think a lot of people jump to conclusions because retail is so much in the forefront of our mind, right? So when a retail company goes bankrupt, it makes headlines, right? Because people care about retail. They associate with retail. They've been in those stores. You could have multi-billion-dollar energy companies go bankrupt and it doesn't even make a noise, right? So I do think there's a huge focus on retail, but really, really important to dig underneath and see why what's happening is happening.
I love that. We're at the end of our time. Just one quick follow-up on something that you mentioned earlier about demographics. What do you see in the demographic changes of the U.S. that will cause and create a lot of opportunities for businesses, but also challenges as businesses have been operating when the population was still growing?
I really think the younger generation is something that we really need to keep our eyes on, because they are changing so dramatically, and their expectations of not just retail, but of all businesses are nothing like what we had when we were kids, right? Like I said before, for me, retail when I was a kid was where can I drive or walk to? Nowadays, retail for these people is everything everywhere. And the challenge for retailers is how do I connect and how do I transact with a younger generation that is all over, the cyber world, right? On so many different platforms, and being inspired by, things that they see online, and then wanting to, connect and transact. And how do I make that happen in an ever-changing environment? And how do I make the right investments in order to make that happen? So I do think keeping an eye out for the younger generation and what they're doing, as we've seen very, very quickly. We used to talk about Gen Z not too long ago,
Yeah.
as being, the kids, they're a major part of the economy right now, and they're being followed quickly by Gen Alpha. So, you don't have a lot of time to adapt.
I don't want to think about it. I think by the time the Gen Alpha are like talked about Gen Z, I think millennials will be like boomer stage. Anything else we didn't talk about today that you wanted to talk about before?
No, I think we hit on a lot of things. It's been great chatting with you. I really enjoyed it.
Okay, last question for me then. 3 words that you think will describe the 2026 economy.
So I do think moderating. I don't expect us to have a blowout year in terms of growth. I think jobless recovery, is that 2 words?
I'll give you. It's a term. I'll give you 1 for that. Yeah.
I do think we are going to see continued growth without maybe the amount of jobs that come behind it. And then I don't think you can talk about 2026 without AI, right? And the impact that that's going to have on our industry, on us as people, and our economy. It's the predictions are, there's so many predictions about where things could go. I may be a little bit less worried than some, but that doesn't mean that I'm not worried about the potential implications of AI as we look into the future.
The agenda for the big show this year, I mean, I have to do a tally later, like the number of AI sessions compared to last year, and Sundar's chat with John Furner, I mean, it was overbooked and I had to come down here anyway. So I think that says everything that you need to know about it.
Well, I think if I was doing a session, even if it had nothing to do with AI, I would put AI in the title, because that would make sure that the room was full.
I like that. That's a pro tip. Mark, thank you so much for spending time with me.
My pleasure, Hope. Thank you so much for having me.